Hi guys, it's Shafman here from Shafman TV. I hope you're fantastic today. Please subscribe to my channel. I'm really happy when I see those new subscriptions, so thanks for everyone who's already subscribed as well. Okay, so today we're going to look at the price of oil and what the inside story is. Now, OPEC met yesterday. That's the Organization of Petroleum Exporting Countries. They met in Vienna and they agreed to extend their supply cut of 1.8 million barrels per day right through, not just till March 2018, right through to the whole of 2018. Now, the fundamental question is, why have OPEC done this? The basic reason is that there is an oversupply of oil at the moment in the market. Inventories are too high, and OPEC are looking to chip away at those inventories, reduce the inventories, and then bring the market back in to rebalance, to rebalance the market. So, give or take different estimates, there's around 3 billion barrels in inventories, and this is way too high, okay? And since the start of the year, due to the cuts that OPEC have enacted, those inventories have been going down around 500,000 barrels of oil per day, and OPEC are looking through 2008 to chip away at those inventories so that those inventories become lower and that the market comes into balance, and then prices can actually rise from that point, because on a fundamental basis there is an oversupply of oil. Okay, and one of the ramifications of the oversupply of oil and of the large inventories is that political risk hasn't really been priced into oil. We've seen the Saudi purge have a small effect upon the price of oil, but generally speaking, in previous times in a tight oil market where you had sort of the potential threat of nuclear war in the Korean Peninsula, or you had the proxy war between Iran and Saudi Arabia, places where lots of oil comes from, you would have seen a positive effect on the price of oil. So political risk isn't particularly in the price of oil. And I think OPEC understand that on a fundamental basis, inventories have to go down. So this explains their supply cut, and this explains why they're looking to rebalance the market. I think on the flip side, and if you look at some of the interviews given by some of the oil ministers, especially the Iraqi oil minister and other oil ministers, you'll see that OPEC are fearful that of how can I put it, getting this correct. This is the Goldilocks situation. If prices rise, OPEC are concerned that shale oil producers, especially in North America, are going to come online with more production and are going to flood the market. This is a major fear for OPEC. So we're currently in the trading range between sort of $60 to $65 a barrel. And there's obviously a concern that if prices shoot above $70 a barrel, then you're going to see shale oil producers coming online and that acting as a natural cap upon prices. Now, whether that happens or not remains to be seen, because at $55 a barrel, many analysts said at $55 a barrel, shale oil producers are going to flood the market. That hasn't happened. The reason that hasn't happened is quite straightforward. Shale oil producers are heavily leveraged and heavily in debt, and their cost of production is probably much higher than analysts thought, and they also at some point have to pay down and reduce their leverage and their debt. And as a result, as the price has gone up, shale oil producers haven't particularly flooded the market as predicted. So we've got a very delicate balancing act here, and and OPEC have got a very difficult balancing act in terms of trying to rebalance the market by reducing those inventories, and also ensuring that shale doesn't take more market share and doesn't bring more production online to then flood the market. Now, on the demand side, demand is going up for oil. Okay, so industrial output looks like it's on the rise, and we're currently consuming just under 100 million barrels of oil per day globally. So demand has crept up, but OPEC on the supply side are hugely concerned, as I say, about shale. Another issue for OPEC is, can they actually implement these supply cuts? Okay, will countries who are really, you can't blame countries like Venezuela or Iran, Iraq, Libya, Saudi, whose budgets are really stretched, okay? their domestic budgets are really dependent upon a higher price of oil, and with a low price of oil, it really causes the temptation for OPEC members to cheat and actually still increase supply and still actually sell more barrels onto the market because of the actual domestic pressure. Another factor, in my view, is that if you look at some of the major Russian oil companies, they've got quite a few new oil fields ready to come onto the market in 2018. They've basically delayed this. So by agreeing the supply cut, OPEC and also Russia, a non-OPEC member, they've delayed this. I cannot see this delay happening into 2019. So I envisage that the supply cut will run right through to 2018. Inventories will probably reduce, and then we'll have to see if oil stabilizes in this range or if it trades at a higher level. But basically, it's a hugely interesting time for analysts and hugely interesting time for oil and oil companies and national oil companies to see where this price is going to go, and if inventories will reduce, if the fundamentals of oil will come back, and if we'll start to trade sort of in a higher trading range as those inventories reduce and as the market rebalances. So in my opinion, it's something for investors to look at. It's something also to be aware of if you want to understand the Middle East and you want to understand some of the politics happening in the Middle East. And it's a very fascinating time. So hope that's been useful, and thanks for watching. Cheers.